Well, why should we still worry about deficits?
Well, I'd like people to think in two different time horizons. And it's hard to think in very long horizons and then to do the sort of mental time travel back and forth. So if interest rates are higher, we'll find it harder to finance these deficits. And there's a school of thought that says, well, interest rates are low and it's likely to stay that way. So why worry? And I think there was a lovely piece of work done by Joe Stiglitz and Bob Rubin and Peter Orszag that published about a year ago, which they said that's the wrong way to think about it. Interest rates are low and it's been surprising us. And we shouldn't draw the inference that that means they'll always be low. We should draw the inference that we're bad at predicting interest rates. And therefore, we have to account for that when we think about what we're doing. And I thought I love that way of thinking about it. And I think that's an important caveat or sort of little footnote to drop down for people who says, well, we don't have to worry about the deficits because interest rates are low, so who cares? Mm-hmm. But the longer time horizon, I think, really matters, which is when borrowing from ourselves in the future indefinitely is kind of an Achilles heel of democracy. We shouldn't be letting the current generation burden future generations so we can live a little better. I think that's not what we really mean by democracy. And so the states, I've come in my old age, my impending dotage, to have much more respect for those states that are really tough on borrowing. And what it's done is force those states here to have capital budgets, whether they admit it or not, that there's some sort of long-term investments you make in infrastructure in your state, and that's okay to borrow for that because you're getting a long-run return. But we shouldn't be borrowing against the future to support current consumption just ad infinitum. Now, we want to do that countercyclically when we have a recession, when we have a pandemic. We want to do a little of that, but to sort of do it on an open-ended basis that it doesn't matter that we burden future generations so we live better today and they'll pay it off. I think that's a real failure of democracy. And I think the people who say deficits don't matter just don't want to confront that kind of horizon and that kind of dilemma.
I think the unfortunate thing about that, though, is they've kind of got evidence on their side. I mean, this is sort of the debate that I faced in 2017, working for a Republican member of the Senate and not being really enthused about spending $1.5 to $2 trillion in deficit finance tax cuts. You make the argument that I learned in Econ 101 is that when the government spends massively, interest rates rise and crowds out private domestic investment. And making that argument in 2017 and trying to convince some of the people that I spoke with then that, maybe we shouldn't be doing this. They all point to the fact that, hey, we've doubled or tripled our debt in the last 10 years, and there hasn't been any kind of movement in interest rates whatsoever, that somehow we're special. And so I again, it's hard to prove a counterfactual. So we in theory, we know that massive debts either have to be repaid or they cause higher interest rates in the future, but we're not seeing it. And I'm wondering how do you respond to people when they say, okay, but we haven't seen this rise in interest rates. Is the United States special in some way? How is it that we've been able to defy gravity?
When the central bank makes money free and plentiful, it's very hard for markets to price anything. And I think it's just too easy to say, oh, well, see, there's no problem. Well, the Fed is making money free and plentiful, and it corrupts the system. Mm-hmm. You're not going to get a risk premium. When I was both at the Treasury 20 years ago and over the next decade, I'd get questions all the time from people in the national security side of the government saying, why aren't markets more upset about all these national security risks? And I'd say, because money's free. It's hard to get a risk premium when money's free. So if you look back at the 1970s, there was a long period of time, and it's relevant for today, in which bond yields were below the level of inflation. And that's because the bond market is responding to the Fed. Now, the Fed responds to the bond market. It goes back and forth both ways. But we have the same issue now. Inflation's above 5%. Bond yields are all way below that. So we could say the Treasury market's underwater. And we have a central bank who is very comfortable with doing this. Now, I don't predict the future, but I try to understand the past. And the biggest mistake the Fed made in the late 1960s and 1970s was not to notice that when inflation rises and the Fed holds nominal interest rates flat, real interest rates have fallen, and we've just experienced an easing of monetary policy when real rates fall. That's stimulating the economy. That's what the Fed's doing now, and they're claiming it to be a virtue. They're saying inflation's rising, don't worry, it's temporary, but we wouldn't dream of raising rates to try to catch up with it. Well, that was what Chairman Volcker and Chairman Greenspan learned to do. You can't sit still then. You have to raise nominal rates to make sure you're not easing policy further while inflation is accelerating. And this Fed has turned this into a virtue by linking their average inflation targeting mantra, which is in principle okay, but they've linked it to extended forward guidance. So they're pre-committing themselves to do what we learned in the 1970s was irresponsible, to allow real interest rates to fall while inflation is rising. And they're hoping to be lucky and get away with it. And maybe they will, and maybe they won't. But I try to teach my students, we don't get to judge the quality of decision-making by the outcome. That doesn't leave room for the role of chance and all sorts of other factors. And the late Thomas Schelling of Harvard, Nobel laureate, taught us that in various ways. And so I don't think the Fed's going to be that lucky. And they're going to have to play catch up, but maybe they will be. But that doesn't mean it's wise